You know, currencies, it's such a good question that you kick off there, because these are the big markets. Essentially, there's been quite a bit that has suddenly seen a directional change. The Federal Reserve was the lead hawk on inflation. They did 4 0.75 hikes, you'll recall, which is, you know, 3/4 of a way to a full point back to back. And so the dollar was getting quite a bit of implicit support in that, although it may not have felt like that initially. And as a result, recently, there's been a whole bunch of dovish events that have occurred. First of all, you had the Fed hold. They didn't do any further tightening. Then maybe they had a little look into some other stats that I'll be talking about now. Then we had we did our live trading day on non-farm payrolls, because markets often take key direction off a big data number. And we saw payrolls was an undershoot for the first time it was the 15th month. You had 14 in a row overshoots above expectation. You know, the great Bidenomics was working a charm. Everybody, the red hot labor markets. We have our reservations about the authenticity of all of that with the birth-death model and everything else that goes into statistics. But the long and short of that is where there was an underperformance in labor markets. There also then was the CPI that came in low as well. So the CPI came in low, and everybody suddenly started to see a fall off in the dollar. So roundabouts, and I think actually it's always best to talk this through to you almost with a chart in view, because then everyone can see it's happening, and they can also spot the disorderly nature of it, Andy. But in essence, we went from a very hawkish Fed to quite a sudden, it's almost as I described, it's a bit like leagues and lags. You were accelerating really fast, and then someone hit the emergency brakes, and you got thrown onto the bonnet there a little bit. So it was a bit of a cooling of the inflation is everything aspect with an undershoot. And today we got an undershoot on retail expectations as well, which was a 0.2 against 0.4 numbers and a 0.2 against 0.5 expected numbers. So everything in those stats has pointed to quite an abrupt slowing down. And one of the things that typically happens is markets is that they pre-price forward 6 months. It's a discounting mechanism for 6 months into the future. So let me just jump to that chart share and show you where we were and how it's gone, because that's going to add a bit of color to some of what I'm saying. So with a bit of luck, you'll be seeing the dollar index there. Yep. And I think I said last Friday, I meant the Friday before. Of course, it was the last Friday of the month. We're already mid-July already. So we've skipped on a little bit. The weeks are just hurtling by. But that was essentially the non-farm payroll numbers. And I'm going to, in fact, let me go a little bit further out. We're on the 4 hour. Let's take it to the daily just to give you this entire technical structure and how it's framed. So we actually love trading low volatility moments into expansive moves so that we can get super tight on that risk with a bit of leverage and have an explosive move away. That's to the downside and also to the upside. So you'll see that this was a squeeze of form on the dollar index. And what we tend to find is just before a major level, especially if it's going to be a headline grabber, like running 100, that's the 100 line on this blue line over here, and that's the 100 number, you tend to wind up and get a bit of momentum. So key levels are broken with momentum. And you'll see that from around, as I was describing the trading day, non-farm payrolls that was over here, you could have got shorted around 103. Our last get short moment is that third low over there on the green line. And we have a projected target for 97 on the Dixie. And what's happened is this has been pretty abrupt, and disorderly is the word they don't like in the Fed, but a disorderly descent in the value of the dollar.
Okay, can I interrupt you just for a second? Because this is a key point. Are you saying that right before a big move, volatility is compressed, or are you saying that it expands and then it breaks through?
It compresses first, and the compression is the gift.
Got it.
So the gift is the compression because
that's what it shows in the chart.
100%. And you can see we sometimes refer to this even in our own lexicon as funneling. It's called the HV method, the Hunt volatility funnel. This is almost like guys who make protein shakes in the gym. You'll have a large male audience, I'm sure. Sorry for the ladies, but you have a funnel there for powder, putting your powder in your plastic container.
And for our listeners there, we're looking at the dollar chart here, and you see a very nice channel, but it's very tight.
Absolutely. And the compression leads to later high momentum moves. So the greater you compress price activity, when you get extremely low volatility, it's usually a precursor to a move. And actually, you've got a lot of equity traders in your audience pre-major earnings results. It's natural for volume and volatility to dry up.
Right.
Then you get a real repricing in. Now that's known fundamental events, but technical and fundamental, just two different sides of the same coin. And we get to see unheard of or unpriced in event data before it's made public. Chasing on the news is always meaning you're arriving late. So I was a news trader. I gave up. I was always selling, buying the highs and selling out on the pullbacks.
Me too.
Yeah, the key point is to be in there before everybody else is in there. And for that, you need to not know the narrative, but to trade the technical. You get the narrative afterwards. So it's almost like buying a book and not knowing the story you're getting, and then reading it afterwards after you've won the prize. And that's kind of our approach. So it's a little bit back to front. And this has given us a very strong sell-off. So I actually went Swiss franc and Norwegian krona, got 2 shorts on the dollar on those two. But the euro's been pretty damn good as well on that front. And we're pausing. This is typical technical behavior when you run a key level. You first run it and then you muck about a little bit at that key level. You may even get a little bit of a pushback, but there hasn't been.
Let me interrupt you really quick. Why did we bounce right there? All right, we didn't even really bounce, but why did we stop right there? If you can expand the chart.
Because key levels of significance, the 100 value. What tends to happen is a lot of people may have set targets at the 100. So people are round number orientated. Can I also point out? Derivative markets are all based on round numbers, even on equities. You get Apple $100, 110, 125, whatever. You're going to get the round numbers. No one's pricing 111.8 a call option.
Let me interrupt you about that. That is very, very significant, and I'm so glad that you trade that and pointed that out. I didn't notice that at first on the chart, but I see it there. I remember an old-time trader that I used to trade with. He used to trade specifically and almost exclusively round numbers because they act as a magnet for a market. Go ahead.
And we go a little bit further in terms of our HVF method rules. The round number is a magnet, and typically you should trade through them. They should be broken. So what typically happens is everybody doesn't get filled at 100. Because there's a deluge of orders. So we talk about vacuums and voids in volume by price. So volume by price is a little known thing. Well, it's quite well known depending how engaged you are in the markets. But if you in fact pull a bit of data across, you get instead of the histograms at the bottom under the day, you get the histograms by price. So they're horizontal histograms. And what you tend to find is there are voids just before the big round numbers and just after them. In other words, there's not a lot of bid stack. Nobody prices to sell at 99.97. Most people go 100, and no one prices at 101.01. They just go 100 or 100.001, for example. So you tend to find that there's voids. Now, when the ladders have these vacuums and voids, these gaps, the market price behavior shoots very promptly through them. This is why you often find very significant levels are smashed through with quite high momentum, and then you get a pull back. So you clear the void area, and then you start to hit the stack, and then you've done a lot more move than people expected, and then you get a natural pullback. So this is
I look at it as the market. I'm sorry for interrupting, but I look at it as the market taking out all the stops, if you would, taking out the novices, if you would. That's why it goes through that either on the upside or on the downside.
A lot of people will say that because they're on the wrong side of the market. It does feel that way. When you're on the wrong side of the market, it feels that way. Once you understand what I'm saying, it's just price behavior doing what it does.
What it should be doing.
Because you were long when you should have been short, and you had a stop on the other side of the 100 level, and you thought, gee, it just did just enough to run that 100 level and take my order out. You you where I was at in the early stages of my career, feeling unlucky. The minute you start positioning and understanding the concept of price behavior better, you start to feel a little luckier. You don't seem to be just shaken out at all these key points. And that tends to happen. And sometimes people get a bit conspiratorial. Listen, I'm right up there with conspiracy. Most things are rigged. There's a lot going on. But you also can't undermine yourself and let it be a license for not owning your own outcomes in the trade market. Oh, my broker stole from me. My broker stole from me. I get a little tired of that, and I train that out of traders. They're enablers. They're allowing you access to the market. They're taking risk of their own. If you've oversized, you could have had a deeper stop. If you were smaller in size, etc., you have to understand the rules of game. It's almost like in the South African reference, you've got to play to the referee. This is a bit of a rugby one. Sometimes they have a bit of a bias. They're more strong on certain rules than others. You've got to be adaptable. So we've got to always own our own outcomes. So I just stop people from allowing that one to manifest too much because it'll block their progress.
Yeah.